How to pay yourself as a director of a limited company in 2025-2026. What is the most tax efficient way to pay yourself? That's what we're going to be taking a look at in this video. Now, before I get into the content, I just want to say I am not an accountant. This is not financial advice. However, I have been making these videos for the past 6 years. They've always been well received, and I've been a business owner since 2008, so that's coming up 17 years now. So I am confident in the information I'm telling you, and I've also verified these figures with my own accountant. So let's jump into the video. Now, before I give you the figures, I want to explain why I choose to pay myself this way, as if you're going to trust some random guy on YouTube, I think it's reasonable to at least get an explanation as to how I arrived at these figures and these recommendations. So let's start by taking a look at all of the elements you need to consider first, and then we'll look at the figures later on in the video. So first, income tax, and you need to understand all of these elements, otherwise none of it will make sense. So just to recap, income tax. This is paid on your income and salary, and it excludes dividends. And that's important. I'll come back to that later on in the video when we explain dividends in a bit more detail. The income tax rates for 2025-2026, and this applies to many of the taxes that I'm going to be talking about in this video, is the thresholds have remained frozen. Now, there has been one massive change to national insurance, which I'm sure you guys have seen in the news, and I'm going to be covering that in detail and exactly how it's going to impact you and your business. But income tax rates have been frozen. This is known as fiscal drag. So instead of the government saying we're going to put your taxes up, they just freeze the threshold, and with inflation and as people's wages go up, they collect more tax. So via fiscal drag, they are actually increasing taxes without telling you directly. So the personal allowance, this is the amount you can earn tax-free. That remains frozen at £12,570 per year. And you've got the 20, 40 and 45% brackets there that have also remained frozen this year. And also at the bottom there, please note, you lose £1 of personal allowance for every £2 you earn over £100,000. So as soon as you hit 100K, you start to lose this personal allowance. So between 100,000 and 125,000, because you're losing £1 of personal allowance, you are basically taxed at 60% between 100,000 and 125,000. So that is income tax. We're now going to take a look at national insurance. And this is the big one. This is the one that has been in headlines since the budget at the end of last year. So I'm going to spend a little bit more time on this section. So there are a few different types of national insurance. I'm going to explain them all briefly and then really focus on the key one. So the first one is called the LEL, which is your lower earnings limit. And this is what I call the state pension threshold. This is the minimum amount you need to pay yourself via a salary, not via dividends, this is via a salary, to qualify for your state pension token. And I think you need 35 state pension tokens over your career to get the full state pension, if it still exists by the time that we retire. But this is the current setup. So you want to earn at least £6,500 to qualify for that token. The primary threshold, this is the employee's threshold. So you are an employee of your own limited company. So the threshold in 2025-2026 is still aligned with the personal allowance. So it matches the income tax threshold. So £12,570 before you pay any employee's NI. Anything above that, and you pay 8% all the way up to the second income tax threshold, which is 50,270, and then over that, it falls back down to 2%. So that is employee's NI. Now, this is the big one, the secondary threshold. This is the one that's been in the news. So last year, the threshold, the point at which your business, so your limited company, the employer, started paying national insurance was £9,100. And this has been reduced massively down to £5,000. So as soon as you have one employee in your business, and that includes you, receiving a salary above £5,000, your business will start paying employers' national insurance. And they've also increased the rate from 13.8% to 15%. And then if you do earn over 50,270, unlike employees and I, which falls down to 2%, this continues at 15%. So this is why we choose to pay ourselves the way I'm going to show you in this video, as we want to avoid this trap of combined employees and employers and I, which peaks at 23% if you add the 8% to the 15%. And I'm going to show you how these figures break down later on in the video when you see how much extra tax, unfortunately, you're going to be paying this year versus last year. So next up, we have corporation tax. And this is quite straightforward. So it's payable against net profits made by a limited company. Allowable business expenses can be offset against profits to reduce your corporation tax liability. So your salary and your employer's NI are allowable business expenses. And the corporation tax rates for 2025-2026 remain exactly the same. You've got 19% for most small businesses with profits below £50,000. You've got marginal relief, then up to £250,000, and above that it is 25%. And then finally, we have dividends. And once I've gone through dividends, I am going to talk you through the figures and the way I recommend paying yourself in 2025-2026. So dividends are only payable to shareholders from profits or retained profits from previous years. So if you've just started a business and you haven't made any profits yet, you shouldn't be paying yourself with dividends. But if you've got an active business, you're doing well, paying yourself from dividends is often the most tax efficient way to do it, in addition to a basic salary, which I'm going to clarify on the next slide. Dividends can be paid throughout the year. These are known as interim dividends. So I personally pay myself a dividend every single month. And I wanted to clarify that, as a lot of people don't realize you can do that. You can pretty much treat a dividend like a salary, providing you know you've got enough profits in the business. You can pay yourself a regular, consistent dividend, or you can pay them at the end of the year after the annual accounts, and then it's called final dividends. The tax on dividends is paid via self-assessment. So if you were paying national insurance, you'd be paying that on a monthly or a quarterly basis. But with dividends, you do your self-assessment and then you'd pay the dividend tax at that point. There is a tax-free dividend allowance of £500. It used to be much higher than this, but it's come down a lot over recent years. And that basically means you can pay yourself £500 of dividends from the business completely tax-free. And if for any reason you've paid yourself below the personal allowance of £12,570, you can also take the remainder of that as tax-free dividends as well. Now, dividends are not subject to national insurance or income tax, which is why they are often more tax efficient than just paying yourself a full salary. And the dividend tax rates for 2025 remain unchanged. You've got 8.75 for the basic rate. You'll see the basic rate there is slightly different to what I have on the income tax, because what I've done is I've added this £500 of tax-free dividend allowance to the personal allowance. So instead of this being £12,571, it's £13,071. But these are the dividend rates. Now, keep in mind, as you're only paying dividends from profits from your business, you will have paid corporation tax on that income first. So you would have paid corporation tax, say, at 19% on those profits before you can pull them at dividends. So you aren't only just paying this tax, you are paying corporation tax as well. So that is income tax, national insurance, corporation tax, and dividends explained. And before I give you my recommended salary for this year, if you're finding this content helpful, I'd really appreciate it if you could hit that like button. And if you want to see more from me, subscribe to the channel. So the most tax efficient director salary in 2025-2026 for many, many people. This doesn't apply to everyone, as everyone's got their own individual circumstances. And I would always recommend speaking to your accountant about your individual circumstances. But certainly this salary will be the most common salary paid this year. So my recommendation is to pay yourself £12,570 as a basic salary. This is £1,047.50 per month, and I'm going to explain why in the following points. And above this, you'll pay yourself using dividends. And the reason we pay yourself above this using dividends is to avoid the double NI that I spoke about. I think it was 23%. And the income tax you'd be paying as well. So instead of paying, say, 20% income tax or 40% income tax, plus 2 lots of NI on top of that, it's more tax efficient to pay yourself a basic salary and then dividends as well. And I'm going to explain that further as we go through this slide. So by paying yourself £12,570, you're making full use of the personal allowance. So there's no income tax due on that amount. And as I mentioned earlier, it's also an allowable business expense. There'll be no corporation tax to pay on that. It's also above the LEL, which is the lower earnings limit national insurance threshold. So you qualify for the state pension, and it's below the primary NI threshold. So there's no employee's NI due. So you qualify for your state pension, and as an employee of your business, there's no national insurance due either, as you're below that £12,570 primary NI threshold. However, it's not completely tax-free because it is above the secondary NI threshold. So that's the employer's NI threshold. And if you remember on the national insurance slide, we spoke about how that had decreased, or is it increased? The threshold has gone down, but the amount of tax you're going to be paying has gone up. So you will start paying national insurance as an employer as soon as you're above £5,000. So between £5,000 and £12,570, which is what you're going to be paying yourself, you're going to be paying employers' NI at 15%. So £7,570 at 15% is you're paying £1,135 of national insurance as employers' NI. Now, compared to last year, when the threshold was £9,100 and only 13.8% on £3,470, which is the difference between that, you have 13.8%, you paid £478 employers' national insurance. So this year, when you deduct that from what we're paying this year, we're seeing an increase of £657, which I'm sure we've all got our own opinions on that increase, but it's a huge increase. But it's still more tax efficient than paying a lower salary. So some people will be tempted to pay themselves a lower salary below this secondary NI threshold, but you're still saving money by doing it this way. So yes, we're paying NI at 15%, but if we pulled all of our income as dividends, then you're still paying 19% corporation tax on that first. So you've still got 4% saving. Plus, remember this NI, you get the corporation tax. You can offset it against corporation tax as well. So there's a little bit of saving there as well, which I've just got on this next slide, which is NI is an allowable expense deductible from corporation tax at a minimum of 19%. So based on that amount, you'll be saving about £200 in corporation tax by paying yourself this way. So national insurance payments will need to be made to the HMRC either monthly or quarterly. And finally, the employment allowance has increased to £10,500. This was previously £5,000 last year, so this is quite a big increase. The catch is this isn't available to sole director limited companies. It is available if there's two directors, maybe a husband and wife team, or if you've got an employee. So I've got here, it's available to limited companies with employees, including husband and wife directors, earning above the NI secondary threshold. So providing you have another employee in your business earning above £5,000, which is the new secondary NI threshold, then you can claim the employment allowance. So if there is more than one of you in the business, then potentially you can offset this entire amount. So you can save over £1,100 in national insurance by claiming the employment allowance. But unfortunately, like I said earlier in the video, this isn't available to sole director limited companies. Now, to wrap up this video, if you found it helpful, I'd appreciate it if you can hit the like button. If you want to see more from me, subscribe to the channel. I'm going to pop a link to my X profile in the pinned top comment. And as national insurance has gone up so much, you're going to be keen to make as many tax savings as possible this year. So what I'm going to do is pop up a video which will talk you through some of the best allowable business expenses for you guys to consider. And I'll see you guys over there.